Good morning. This is Mark Boud of Real Estate Economics. Thank you for joining us for our weekly webinar series. This topic for this morning's webinar on August 11th, 2010 is a first of a two-parter for the state of California. What I'd like to do this morning is show you those overall market trends in terms of housing market conditions and distressed housing this morning. And then I'm going to follow that up next week with an economic forecast for the entire state that will cover our 5-year forecasts. I'll also show you forecasts for the housing market and show you how that influences price appreciation, not only for the next 5 years, but we'll also give a long-term forecast to year 2025 to give you an idea as to what the overall cycle may look like during the next several years. Before I do that, let me share with you our overall schedule in terms of webinars. The California Part 1 and Part 2 webinars during this morning and next week will be followed by Denver, Colorado on August 24th. You can pull up our webinars at our YouTube channel as well as www.realestateeconomics.com. Let me just share with you information regarding our residential economic report. Most things that I share with you on our webinar stem directly from the residential economic report, and some of you may not realize that we have this report for every major metropolitan area within a 14-state area. And we hope you will take advantage of that. In fact, those of you who want to take advantage of our residential economic report and purchase an annual subscription, we're offering a special deal. And we hope that you'll contact us, including Judy Duell or Sandy Rivera, to take advantage of that special webinar deal. So let's jump right into the housing market conditions for the state of California. First, by showing you overall patterns during the past 24 months for housing market trends. Here we are in June of year 2008, being compared with June of year 2009, where housing transactions rose quite a bit. Now they've dropped off. At least the single family have dropped off during the past 12 months, while condominiums have remained relatively flat during the past 12 months. This isn't much of a concern because most of that drop-off is a reduction in distressed housing activity. You'll see that here by a comparison of housing transactions by type. Here we are for resales 24 months ago. Here's where we were 12 months ago, and they actually jumped up quite a bit during the most recent period of June year 2010. Now, our definition of resales includes short sales. What we've been seeing is a lot of banks have been much more effective during the past 12 months of, instead of going into foreclosure or foreclosing on properties, they are working with owners to produce a short sale. They've been effective at doing that, which has caused resale volume to increase, while it's also caused foreclosures to fall. You can see foreclosures shown in red 24 months ago. Here we are 12 months ago. Here we are for the most recent period, down quite a bit from where we have been during the past 24 months. In fact, foreclosure sales have also dropped, where the banks are selling back those foreclosed properties to new owners, but they remain above foreclosures, and that's a good sign because what it means is that we're getting a net burn-off of distressed inventory. One more comment on transactions by type is the new home market is actually beginning to see some improvements. Here we were 24 months ago, followed by 12 months ago. It dropped quite a bit, and it's actually increased during the past 12 months. Part of the reason it's increased is because we've seen more housing construction, mainly by the public builders, in terms of building on finished land. They're not improving land yet, but they are building on the inventory of land that's already been there for the past several years. And there's been a good reaction to that with the very strong values that are being offered. They're selling more of them and closing more of them, mainly in the coastal counties, a little bit of improvements in some of the inland markets as well, but it starts at the coast and it's moving east. We think that overall trend will continue as long as we have that inventory of finished lots that they can build on. But that's rapidly disappearing. And so we're actually entering into a phase where we might even see further decreases of supply, new home supply, during the next 3 years as we continue to burn off that distressed or that finished lot inventory. Here's what the overall trends look like in terms of prices. We started June of year 2008 at almost $229 per square foot, dropped quite a bit 12 months ago. Here we are right now. We're actually up by about 10%, both in terms of price per square foot and overall average price. Now that's a good sign, but I hesitate in calling that appreciation. It's mainly a reflection of selling fewer distressed homes, and at the same time, we're selling more homes in those more preferable areas of California, more expensive areas of California. And so though it's a positive trend, and it does definitely suggest that depreciation has stopped, not all of this 10% increase during the past 12 months has been associated with appreciation. Here's the overall transactions by type. By price range. Something that's interesting is you can see that transaction volume actually increased during the past 12 months for product above 800,000. Those more affluent buyers are not quite as sensitive to the tightened lending environment as those who are purchasing below $800,000. You can kind of see that here with the mortgage amount of loan-to-value chart, where we've actually dropped in terms of loan-to-value or mortgage amounts as a percentage of the overall price. We're down to 89%, suggesting that the overall average level of down payment is 11%, higher than it was 12 months ago, a reflection of fewer FHA and VA loans that are being given out and a much tighter lending environment. We are finding alternative sources of lending, and one of the most common is the bank of mom and dad, as a lot of adult children are turning to parents in order to fund a transaction for a home. And most of the parents are willing to do that if they can, because they see they're more effectively able to recognize California real estate as a screaming deal right now. They've been through cycles. They recognize the ups and downs of the market. And they recognize, most of them recognize, that now is a good time to take advantage of undervaluation in this particular market. Let me share with you for the next few minutes our take on distressed housing or shadow inventory throughout the entire state of California. The way I want to do that is show, first of all, foreclosure and notices of default patterns. Notices of default are shown by these yellow bars. Foreclosures are shown by the red bars. Something that's very interesting is that we've seen a significant downward trend during the past several quarters and months in notices of default, while at the same time we've seen kind of a plateau in terms of overall foreclosures. That pattern cannot continue for much longer. Typically, foreclosures have to follow the patterns of notices of default, and so notices of default cannot continue to fall with foreclosures remaining at a plateau. Eventually, foreclosures have to react to that. We've had so much inventory or so much distressed housing in the system that foreclosures have been able to remain high, but we think that as early as fourth quarter of this year, they'll begin to trend downward, and during year 2011, we think that downward trend will continue, following that downward pattern that we've seen during the past several months of notices of default. Now, if you look at this in a different way on an annualized basis, here's notices of default in blue, foreclosures in red, and in this chart we add foreclosure sales. When a bank is selling those foreclosed properties to new owners, that's shown in green. If you take the cumulative difference between foreclosures and foreclosure sales over time, starting at year 2005 and building it up, you get a very good idea of what the overall inventory level is that's being held by the banks in terms of distressed inventory. And here that is, where it's almost negligible in the year 2005, increases a little bit in 2006, it balloons in 2007. 2008 is the highest year we've ever experienced in terms of distressed inventory being held by the banks. They were laying off a lot of workers. They did not have the systems in place to liquidate that distressed inventory, and it built up very, very quickly in the banking system. In 2009, they became much more effective in terms of liquidating it, and the overall level of inventory of that distressed housing dropped significantly as banks slashed prices and really dumped a lot of that inventory on the market, and most of that was absorbed at these very strong values that they were offering during year 2009. 2010, there's a further reduction. It's not quite as dramatic as between 2008 and 2009, but it is a reduction, and that pattern continues until we hit more of a normal level of overall distressed inventory held by the banks by about 2015. So it does take us several years to burn that off, but we are burning it off. And if you take that level of shadow inventory and add it to the overall annual levels of construction that we've experienced, you get an idea as to what true supply is. So here we are at, throughout time, starting in 1991 and going forward to where we are now in year 2010, the annual level of housing construction. We build this based upon the conversion of permits to actual construction. You can see that we hit very high years in 2005, 2006. It dropped off quite a bit in 07 and 08, and we hit rock bottom in terms of construction and supply levels in 2010. We'll experience very low levels for the next 3 to 4 years. But if you add the stressed inventory to that, then you get a more accurate depiction as to what overall supply levels are. And what it means is that year 2008, which was a fairly low level of supply in terms of construction, if you add the stressed inventory to it, it became the highest year in terms of overall supply. It dropped quite a bit in 2009, but that was a fairly high year as well in terms of supply. It wasn't until 2010 that we really began to feel the impact of low supply, at least on the new construction side, and the beginnings of that burn-off of distressed inventory. It gets better and better during the next 3 years as we see continued low levels of housing supply, even after accounting for shadow inventory. What that means is those few builders who are out there able to deliver product should do quite well because their market share will increase in an environment of the beginnings of economic growth and a continued reduction in distressed inventory. So that's it for this morning. Our Part 2 webinar will be held next Wednesday. We'll post that webinar on YouTube at 9 o'clock next Wednesday. And in that, we'll deal with 5-year forecasts for California, both in terms of jobs and housing construction, also in terms of population, household incomes, mortgage rates, all those things that impact our model. We'll show you what that impact is in terms of what overall supply and demand patterns are for housing, as well as price appreciation patterns are for housing during the next 5 years. It'll be an important webinar covering the entire state of California. We hope that you'll join us for that webinar. In the meantime, here's our contact information. Again, if you want to take advantage of those special offers regarding the Residential Economic Report, we'll hope you contact Judy Jewell or Sandy Rivera. Thank you, and we will see you next week. Take care.